So much for all the fears that QE2 would upend the bond market. We are less than 30 days away from the end of the Fed's controversial program of monetary stimulus, and Treasuries are rallying. Yesterday, the 10-year yield dropped below 2.94%, and it is still solidly under 3% this morning. How much lower can it go? Let's find out. Bill O'Donnell is with us from Stamford, Connecticut. Bill is the managing director and head of U.S. Treasury strategy at RBS. Bill, good to have you back on the Inside Track. So, can Treasury yields really drop below 2.94, 2.93%, even further, maybe into the 2.8s?
Well, it's amazing the transformation in the Treasury market over the last, say, 6 weeks, where everybody was fretting about the end of QE2 and the cliff effect upward on rates. And here we are with everybody coming up to me yesterday and asking if I thought there was going to be QE3, given the data. If the economic data continues to weaken, certainly at the same pace that we've seen very recently, then there's no doubt in my mind that Treasury yields are still headed lower. The place to eye is where we were going into QE2 itself, like in the period from August into October of last year. 10-year yields were roughly around 2.35 to 2.4% back then. The market was worried about deflationary risks and a double dip back then, and I guess that's the target up ahead if the data continues to weaken.
Bill, is it just a question of U.S. economic data, or are people like Martin Wolf, the economics columnist for the Financial Times, correct in that some of what we're seeing is a flight of investor capital out of Europe, concerns over sovereign debt? They're driving some of that money into Treasuries as well.
I think it's a couple of other things, and certainly I don't watch the European data or pay too much attention to the TIX flow data that would give indications of money flows between the U.S. and Europe. But what we're seeing is certain investor bases, such as insurance company and pension funds, who are directly exposed to lower rates, coming in, and they've been steady buyers in our Treasury market since January, when yields were much higher. So they seem to be somewhat price insensitive. They need to have Treasuries on the books, and they need to protect themselves from lower rates. At the same time, banks, under the new regulatory reform driven by Basel III, need to significantly raise their liquidity ratios, and that means holding more Treasuries. So there's a new buyer that's coming in as the Fed gets ready to step out.
Bill, so much has been made of PIMCO's Bill Gross and his call on the U.S. Treasury market. So far, he's been wrong. He's sticking to his knitting. He says that investors, he just said this the other day, I know you've read it. He says that investors in the Treasury market are like frogs boiling in a pot. Is he right in that the risk is to the downside, which is to say yields could climb and prices could drop in the near future, or is it the other way around? Or is it somewhere in between?
I think the important answer to that question is all about what's your time horizon. I think in the near term, if you just connect the dots on the economic data, they're showing diminishing growth. And as long as that persists, I think it's going to be tough for those that are fighting this Treasury market, as it has been for the last 5 weeks. But if the time horizon is out 1 to 2 to 3 to 5 years, then certainly the risks are, if you just look at the historical path of Treasury rates, that we're in the low end of the rate boundary of the last 50 to 100 years. And then, therefore, I think it's almost easy to say that rates are heading up for here. So I think it's a matter of timing, and I think that's the important question to ask. I think in the near term, the risk is that we get still lower in rates.
Bill, very quickly, let's cast our eyes forward to a much shorter time frame tomorrow and the jobs report. If we get a big disappointment on that number, the consensus is still 170. It may drop a little bit today as some economists come out with new forecasts. What is that going to mean for Treasuries?
Well, for the last, in recent months, let's say the last 6 to 12 months, everybody's been waiting for that big 300,000 print that they knew was lurking around every monthly release. They never got that. And what's very interesting is that after we got the ISM data yesterday, a lot of people, and the ADP report, a lot of people dramatically throttled back their expectations for tomorrow's numbers. People that were thinking 150 to 200,000 in tomorrow's print, now down as low as 100,000. So I think the hurdle for a good outcome tomorrow is very low. And therefore, I think it's going to be really tough for for people that are long Treasuries below 3% in 10-year yields to get some satisfaction unless we get an absolute disaster of a number into the double digits or down toward flat.
Bill, thanks so much. Bill O'Donnell, head of U.S. Treasury strategy at RBS Securities, was with us from Stamford, Connecticut.